Well, good morning. I'm Bruce Weber, Willem Quaker Dean of the Zicklin School of Business, and I'm pleased to welcome you to this episode of Zicklin Talks Business. Today, we'll examine how private credit firms are disrupting traditional banking businesses. Private credit and direct lending are characterized as loan financing provided by non-bank financial institutions. Private credit assets were valued at nearly $2 trillion in 2024. And in this webinar, we'll explore the market for private credit and how it functions. Who are the lenders and where do their funds come from? Why would a borrower choose a private lender as opposed to a bank? Private credit is less regulated than traditional lending, and some have argued that regulatory arbitrage can explain the growth of private credit. We'll also consider the overall implications for traditional banks. Are they losing their best corporate customers? What lending will remain with small and with large banks? And what does it mean for the banking industry as a whole? How will banks react to this nimble character targeting their markets? Larry Zicklin, Baruch graduate, class of 1957, will discuss these questions with our two panelists who collectively have decades of experience in credit and the banking industry. Hank D'Alessandro is a managing director of Morgan Stanley and is the vice chairman of Morgan Stanley's North America private credit team. Hank joined Morgan Stanley in 1997 and has over 30 years of relevant industry experience. Prior to his current role, Mr. D'Alessandro was vice chairman of North American Leverage and Acquisition Finance and head of U.S. financial sponsor leverage finance. Prior to joining Morgan Stanley, he was a vice president at Chase Securities and audit manager at KPMG Pete Marwick. Mr. D'Alessandro earned a B.S. magna cum laude from Seton Hall University and an MBA from Cornell University. In 2023, Hank was elected chair of the Board of Regents of Seton Hall University. Professor Ken Abbott retired from an impressive banking career in 2018 as Barclays Bank's America's Chief Risk Officer. Before Barclays, Ken was Chief Operating Officer for firm-wide risk at Morgan Stanley for over 9 years. While at Morgan Stanley, he covered commodities, rates, foreign exchange, retail, and emerging markets businesses, and was the Chief Risk Officer for Morgan Stanley's buy-side activity. Ken spent 14 years at Bankers Trust in several trading, research, and risk management roles, and 5 years at Bank of America in senior risk roles. Ken Abbott currently sits on the boards of the New Jersey Scholars Program and the Harvard Club of New Jersey. Ken earned his bachelor's in economics from Harvard University and a master's in economics and in statistics and operations research from New York University. He's an avid musician, playing clarinet, oboe, and tuba. There will be time near the end of the session for questions from the audience, and you can submit them via the Zoom chat feature to my colleague and associate dean, Gwen Webb. Once again, our moderator is Larry Zicklin, who's the former CEO and chairman of Neuberger Berman and also teaches in the Zicklin MBA and undergraduate honors program. With that, I'll hand it over to you, Larry.
Thank you very much, Dean Weber. Appreciate it. Let's begin right at the beginning. Bruce Weber talked about the definition of private credit. I just want to make sure both Ken and Hank agree with that definition. Ken, why don't we start with you? What is your definition of private credit?
I think of credit as something that is primarily dispensed from banks that are within the federal and state regulated banking systems. This is the classic description of this. That's the way I always thought of it.
And Hank, would you add anything to that?
I will, but first I want to thank Dean Weber and Baruch College for including me. I'm thrilled to be here today in this very distinguished panel. It's a real treat to be joined by my good friend Ken Abbott, who was on my investment committee for a long time at Morgan Stanley. And Larry, it's an honor to be on a panel with you. So thank you. So I would define private credit as credit provided by non-banks and not in the securities market. So not high yield, not syndicated loans. So everything kind of in between. So largely non-traded, non-bank product, non-securities.
Could they include distressed credits?
Absolutely, yeah. The whole from investment grade to direct lending, unitranche, mezzanine, and distressed.
Dean Weber, mentioned that it got into 2 trillion. I've heard 2.5 trillion. Are those the numbers that we're really talking about in the non-bank lending?
I think circa 2 trillion is a good estimate. Some have a bit lower, some a bit higher. It's a massive market and it's growing very quickly.
I assume it's growing very quickly, more quickly than the banks are growing.
For sure. I think I've recently read a statistic. I think since the great financial crisis, private credit AUM have grown 16% per annum. No bank is growing like that.
Wow. Wow. That means it's doubling every, what, 4.5 years or something
Yep.
like that. Wow. Wow. And who are the major players in this business?
I mean, there's no shortage. I mean, there's literally hundreds, but some of the names that are some of the leading providers include Blackstone, Blue Owl, Ares, Morgan Stanley, of course, Apollo, Bain, KKR. I mean, I could keep going, but those are some of the many firms that are significant providers.
So my old firm, Neuberger Berman, was deeply involved in Blue Owl. And I noticed that Blue Owl, in this recent decline in the market the last few days, is down 40%. What does that mean? I mean, it's down 40%. It's got to be more than price. There's got to be a suspicion that the loans are no good.
I don't know. It's a very fine firm that I know.
No,
It could be technical.
Well.
It could be technical. It could be there's not a lot of flow. Somebody could have shorted it. I don't know. I don't think there's any systemic issues in private credit. It's a very well managed firm, and I know they have good risk discipline. So I would be extremely surprised if there were any issues there.
And do you think private credit in general will have a bad loan problem if this kind of a decline and these tariffs continue?
Well, I think if there's a recession, private credit and all credit asset classes will be hurt. I think what's different about private credit is it's really never been tested when the market is the scale that it is today through a real a multi-year recession with very high cumulative default rates. We've not seen that, but if and when that occurs, I think you will see defaults in private credit for sure, but you'll see it also in the broadly syndicated markets and the high yield market.
Are the products that are offered by private credit the same as those products offered by the banks? Are they offering more products, more services?
No, I would think the private credit firms are offering fewer services, right? So the historically banks would lend a kind of a loss leader, so they could do cash management, derivatives, M&A, high yield, et cetera, to generate fees. Indirect lending, the vast majority of firms are providing almost exclusively just capital. They're not providing the full suite of services that banks offer.
Certainly checking accounts or anything like that. Ken, where do the private equity firms get their capital? We know that the banks get most of their capital from deposits. Where do the private equity firms get their capital?
Well, private equity firms tend to have deep-pocketed clients and who sign up for a commitment. And as the private equity firms make their commitments, they do capital calls on their institutional clients who put up the cash. Sometimes there's lending involved or bridge lending involved, but generally the same people that invest in private equity are investing in private credit to some extent, not completely.
And why do these firms want to invest and have a period of illiquidity in their investment and invest with private credit? What's the advantage to them?
Well, I'll leave some of this for Hank because he's got more direct experience in this. I've certainly looked at a lot of these, but the whole idea with credit, if you look at the average default rates on securities of different grades, loans at different credit levels, you see a very wide dispersion. So the whole game, to my mind, is study the client, study the industry, study the market, and you'll have a better experience. And in my experience, Hank's the best credit officer I've ever met, and I've met hundreds. The ability to find names where there's inherent value not just regarding the risk, because some of these names would have, if they were public, they'd have relatively low credit ratings because of their leverage, but find the quality names with the quality management. And to me, that's the game. That's the entire game. Hank, do you agree with that statement?
Yeah, no, it's definitely credit selection is absolutely critical. I would say investors are allocating capital to private credit uh, because they think they get better risk-adjusted returns, and they experience lower volatility, right? And so we've all experienced in our own investment accounts over the last week or so significant volatility. You just don't see that in the private credit asset class. It's much lower volatility, and frankly, that's the argument for alternatives writ large. You just don't see the type of volatility, and the compensation for unit of volatility is just better in the private markets, and that's probably the number one motivation for investors.
And is there lower volatility because the markets are more opaque and we just don't see the volatility? After all, when you look at a publicly held bank, you can see volatility every day.
Yep.
But you don't see it in private credit because you don't see many of them. The loans are not trading, obviously, and it's opaque. Is that the reason?
Well, I mean, it's an age-old question, right? Some people will cynically say there's low volatility in private markets because private managers don't adequately mark their books. I think that I think a more balanced approach would be, in direct lending, these assets do not trade, and so trading markets therefore are not as relevant. Not that they're irrelevant, but they're less relevant because these are typically when we make a loan, we hold it to maturity. It's quite rare that we would sell it, and so if you contrast that to banks, when banks book a loan held for investment, they don't mark it. There's no mark to market. Where in private credit there is a mark to market. I would say it's less severe because the spreads tend to move in a slower manner, right? So if you look at credit spreads last week, I mean, credit spreads may have gapped out, depending on the market, 50 to 100 basis points or more. I can tell you private credit spreads did not gap out, 50 or 100 bips or more last week. And so what you see is over time, credit spreads tend to widen or narrow. And, I think the accounting literature says that you should mark your book in accord with market precedents, right? So if you're doing new loans at a spread of 500 over SOFR, then for the last quarter, all the deals were at, say, SOFR plus 500, then your book should be marked around SOFR plus 500. Obviously, there's differences for risk and industries, et cetera, but that's generally how private credit funds mark their books. And I would say the vast majority of the private credit firms have their assets valued by a third-party firm, if not monthly, certainly quarterly, and all of them get audited annually.
And just for the benefit of our audience, could you explain what a credit spread is and how it's derived?
Sure. So the way that people price risk in the credit markets is a spread over a base rate. Up until a couple of years ago, for my whole career, that base rate was a floating rate called LIBOR, and that market was ended and was replaced by SOFR, which I think the regulators and market participants, I guess, believe it's a more reliable measure. And so that floating rate market is where like almost a risk-free credit would trade, at something near SOFR. And in the private credit markets, broadly speaking, credits trade from the real tights of 400 over to more than 600 over for first lien credit risk, and that's the level of compensation that investors earn for a measure of risk.
So we learn that investors are investing in private credit firms. They're giving up liquidity because they're investing for some stated amount of time, 5-10 years, I assume. What are they getting in return? If they're giving up liquidity, they're getting something back?
Well, I mean, what they should be getting back is higher net returns than they could get in the liquid markets, and lower volatility, and hopefully better underwriting, meaning more covenants, more call protection. The managers get more access to due diligence before the investment's made, and then more diligence on an ongoing basis to monitor that investment. So that's kind of the value prop that private credit managers are delivering to their LPs, and their LPs are suffering illiquidity and paying higher fees.
Ken, you wanted to ask a question about loan recovery rates?
Yeah, Hank, I'd love to get your opinion on this. When you think about asset allocation, I've been thinking a lot about that these last couple of days. Reason we go into fixed income is because you get this predictable stream of cash flows. But in addition, when we look at recovery rates over the last 70 years, you're talking about 70% on loans, 45% on bonds. Now there's a huge standard deviation around that number, but those are the kinds of numbers that we're generally talking about. What is the recovery experience? Is there any documented recovery experience on loans that have gone south in the private credit market? And is it any different than what we see with the banks?
So I think it's when you say the banks, I think you have to define that. So if you look at there's some data that's been published. If you look at default rates and recoveries of the private credit market and the liquid markets, I think for the period it was I think 95 till 2023. It was a very extended period of time. The private credit markets had both lower default and slightly higher recoveries. Now, the vast majority of that time, the private credit market was pretty small market. It's really in the last, say, 7-8 years where the market has really grown.
Sure.
So if you look backwards, you get lower defaults, not dramatically, but lower defaults, and you get higher recoveries. So, but again, not dramatically. So it does seem, if you look backwards, you had fewer credit charges, and you got higher spreads. So it made sense. It made sense why investors looking at that would allocate, increasing capital to the marketplace. Now, I think as the private credit market grows, I think it just stands to reason that as the market grows, finances ever larger deals, I think that there'll be some convergence in the defaults and recoveries, say over the next 20 years.
Interesting.
Is there any liquidity available to an investor in private credit who suddenly has a requirement where he needs some cash? It's
interesting, Larry. Like that's kind of the emerging trend in private credit. The banks, right? They're trying to seek opportunity within a private credit market, which would seem to be, taking revenue streams from banks. And so there is I would say, fledgling effort to start trading of private credit loans. And I would say right now it's really very limited trading. It's for the largest names in the private credit market. And there's names that are really the size that could have gone to the liquid markets where there could have been some trading, and that makes sense as the markets convert.
Are we talking about the trading of individual loans, or my participation in a private credit firm?
I'm sorry, loans I was talking about, not the LP interest. Were you talking about LP interest?
Yes. Well, okay. Both.
Yeah, I've not seen a well-developed, and maybe it exists, I'm just not aware of it. There's a well-developed, deep LP secondary market in equity funds. It's very developed, very big, lots of volume. I don't think that is yet developed in any significant way in the private credit market, because the private credit market really has just matured in the last, say, 7 years. And in this period, this is an environment where institutions and individuals are increasing their allocations to private credit, not decreasing it. So I think when LPs have sought liquidity, they've done it because some idiosyncratic factor related to their portfolio.
Are the banks financing private credit firms in any way?
Absolutely. I mean, it's one of the great ironies. When I was credit trained in the early 90s, then Chase, now JP Morgan Chase, there was a move 35 years ago to exit middle market lending, right? Because if you think about a bank's cost structure, to originate $100 million loan, say, takes the same amount of work, same amount of monitoring as $1 billion loan. And so it was not a great business for banks. And they did middle market lending to get these other fees, as we discussed. So what happened over time is, if you go back to the early 90s with HLTs, the regulatory treatment of these middle market loans got more severe, less attractive, and middle market companies paid far fewer in investment banking fees than larger companies. So banks really began exiting that asset class a long time ago, right? So if you contrast making a middle market loan for a bank, a lot of work, not a lot of efficiency, not great capital treatment. But today, what banks are doing is they are lending money to other private credit firms that will have 100 or more names in a portfolio, so highly diversified by borrower industry, and they'll lend 50 cents on the dollar. They can do it very efficiently, and they'll get much better capital treatment from the regulators. So it's a much better business for the banks. They can deploy money efficiently, it's cheaper to monitor it, and you get much better capital treatment, therefore much better ROE.
So they're financing their chief competitors.
Well, I don't think they're really their competitors, on the margin, right? So for large, for $1 billion and bigger private credit deals, yeah, private credit is a competitor. But for the vast majority of the market, they're really not competitors because the banks don't want to do that type of lending. The risk profile is too high generally, and it's just not a great business for them because of all the costs of running a bank, including capital. It's more efficient for this type of lending to be done outside of the banks.
I think it might make sense for the students attending to just talk about this concept of capital briefly. I know it's covered theoretically in a lot of classes, but I'm not sure people necessarily understand the idea behind bank capital. There's been a lot of discussion about Basel III and Basel III Endgame, but the idea is that for every asset on your books, you have to have a certain amount of equity capital, which defines the leverage. And what the banks have done, what the regulators have done since 1988, is they've established a set of criteria for how much capital you have to hold, initially by credit rating, but certainly by other factors as well, by industry segment to which you're lending. So banks have to have a certain amount of capital to support their activities. And what the regulators have done through the work of the Basel Committee is to have a set of rules that makes it much, much more expensive to have certain types of assets on your books, some of them being loans with relatively low credit ratings. Another example, this is credit derivatives. I mean, credit derivative market dried up after 2008. The government didn't forbid it, but they said, okay, you could knock yourselves out, go ahead and do it, but you got to hold $1 of capital for every dollar of assets that you own. I think just to make sure that everybody understands exactly what this concept of capital means.
So did the government, in effect, pave the way for private credit?
I inclined to think was certainly part of it. Hank, what do you think?
Yeah, I agree completely. I think particularly, I agree with Ken because I started in the early 90s and there was clear pressure to reduce your non-investment grade lending, and I think that's only accelerated post the GFC. And I don't think regulators are criticizing banks for reducing their non-investment grade lending.
So in effect, the banks have different credit requirements vis-a-vis the government than private credit does. which gives private credit an enormous advantage. Does that make private credit a risk to the banking system, to the system itself, if things start to get very tight in a recession?
Well, Larry, let me answer first because I'm the novice on this. Ken is the expert. There's no doubt there's more risk. There's more risk in lending in the private credit market than there is in the bank market. There's no doubt about that. My personal view is I don't think there's systemic risk in the private credit market, because if you consider the major exposure that banks have to private credit is lending against portfolios. And if you imagine that a generic LBO is financed 50% debt, 50% equity, just to make it simple, and then the banks lend 50 cents against that 50-cent loan, they're really lending 25 cents on the dollar. So, for banks to get hurt lending to private credit funds, asset values have to decline, more than 75%. So I don't think it's a systemic risk to the banking system, but Ken has forgotten more about this area than I know. So Ken, please give the real answer.
I think one of the key concepts we have to think about when we think about systemic risk in the banking system is that of moral hazard. And the fact that for banks, the overwhelming bulk of the right side of the balance sheet of banks is deposits. It's a very high number. If you look at the asset side, something like 50 to 75% of the asset side is loans and 25% is cash and bonds. So we have to think about what that means in terms of the regulatory process. All right. So the regulators are worried that the banks are going to make bad loans, and this is an oversimplification, but banks are going to make bad loans because they're chasing yields. And if those loans turn into a real problem, the government stands behind them, at least for up to $250,000 per depositor. But as we saw with Silicon Valley Bank 2 years ago, guess what? Medium banks can cause problems too, medium-sized banks. And so the Treasury said that regulators are going to stand behind all these banks that are getting in trouble. So there's this concept of moral hazard in order to where gains are privatized and losses are made public. I don't think you have that in the private credit market, at least certainly not to the same extent. Now, to the extent that it's expanding, and Hank and I have talked about this. Initially, private credit, I think people were seeking alpha. I think that increasingly with the expansion of this, people are looking at beta as well, just the way the market moves up and down. I think that from a regulatory standpoint, all right, the people that are at risk in the private credit market are large institutional investors.
Do the private credit firms use leverage?
Absolutely. I would say that.
To what degree?
It depends, but I would think that the market standard is probably 50 to 60% of value would be leverage. Some, of course, more, some less.
Does that worry you?
Yeah, in a diversified portfolio, right now, if you look at public BDCs, those vehicles typically have 100, 200 or more names. So really good borrower diversity, good industry diversity. If you look at historic defaults and recoveries, at 50 or 60% leverage, things have to go really, really badly for that to kind of blow up. So that seems like a prudent leverage level to me. And at that type of advance rate, the banks are viewing it as that are lending as kind of investment grade risk. The credit spreads are like investment grade, and so that seems sensible to me. If you exercise good risk discipline. Now, if you take very concentrated bets in borrowers and industries, that could go south. But I think, I would say virtually every BDC in the public markets are well managed with good risk controls.
I think it's also worth mentioning that banks are typically leveraged now, and there are many ways you can look at this, but 9 to 1, 8 to 1, 10 to 1. So if you're talking about a leverage market that's only leverage coefficient that's only 0.5, it actually looks safer considering the extent to which banks are actually leveraged.
But I'm talking about private credit now.
Mhm.
But wait a minute, when you talk about 10 to 1, 8 to 1, whatever it is, can you contrast that with what happened in the 2008 crisis?
Sure, but
How were
and we
banks
were talking
leveraged?
about this before we started. If we look at where Morgan Stanley and Lehman and Goldman were, and remember these were regulated by the SEC. Now the SEC's job is to make sure that you're not ripping off your client, and to make sure there's no insider trading. So nobody ever expected the SEC to have to do what we call prudential regulation, make sure the system is safe. That was the Fed's job. And with the collapse of some of these much more lightly regulated investment banks at the time, we saw a huge change in the way that people think about the market. And when Morgan Stanley and Goldman Sachs, after the collapse of the Merrill Lynch and Lehman and Bear, Morgan Stanley and Goldman were banging on the Fed's door saying, please let us be commercial banks. One of my lasting memories from the crisis is the first time the Fed guys showed up, because we hadn't been regulated by the Fed. The Fed guy looked at me and said, Ken, we're as scared of you as you are of us.
And my recollection is, and please correct me if I'm wrong, the banks in those years, the investment banks I'm talking about, were leveraged 30 and 40 to 1.
Yeah, absolutely. Absolutely. In the high 30s, very, very typical. And one of the reasons why we didn't see a panic when markets dropped 30% in COVID, or when they dropped 20 odd percent over the past few days, is that banks have much more capital to support their businesses than they had in the past.
And by the way, just for the benefit of our audience, we're talking, let's use 30 to 1 leverage on the reporting dates, the quarterly reporting dates. We're not
Yes,
talking about what happened between the quarterly reporting dates on the other 90 days.
sure. And as a reference, and Hank, you can cite more statistics than this. And when we look at a corporate, and I'm not necessarily using the same measures of leverage, but when we look at a corporate and we say it's levered 5 to 1, we're like, whoa, there's a lot of risk in that company. The leverage standards for financial institutions are markedly different than what they are in corporate America.
No question. No question.
Ken, for the benefit of our audience, Ken, can you talk about what window dressing is, just so our audience knows?
So companies have been known in the past, and it's been a few years since I've been in the business, to do trades near the end of a reporting period to put risk off their balance sheet. Now, sometimes this is used for very legitimate reasons. Other times this is used to hide the risk profile. So basically what you could do is you could tell someone that to take the risk off your books, to hold this risk for 5 days between December 27th and January 2nd, for example. And then you'd reverse that trade out. So at the period end, and we see this, and Hank can speak more to this, what goes on now, but certainly I've seen many instances where companies prettied up their balance sheets for quarterly reporting, and particularly annual reporting, only to lever up the day after the books close.
Yeah, I think what you see in the private credit market is oftentimes an effort to be compliant with covenants. You know, a company may not pay their vendors on time around quarter end to make sure that their net debt is at a level that is compliant with their covenants. So yeah, so I think it certainly happens in the private credit market for sure.
Talk about banks taking market share. I'm sorry, private credit taking market share from banks. But my guess is they're not taking it uniformly across the board from all banks. I suspect they're taking it more from middle market banks than the large banks. Is that fair? Who is giving up market share?
Well, I think if you look at the whole banking sector, the banks have lost share, lending share, for at least 35 years. It's probably longer than that. I think you have to look at, you know, which bank, right? So the 6 largest banks are massive, and most of them do very little middle market lending. So they're not really losing.
Whoa. Just stop there. The six largest banks do very little market lending.
Middle market lending.
Middle
I think
market
that,
lending?
yeah, I think JP Morgan does. I think B of A does. But Morgan Stanley or Goldman Sachs, for sure, are not doing a lot of middle market lending with their own balance sheet. They're doing it through their asset management business, for sure, in a significant way, but they're not doing it on balance sheet. And frankly, I don't think either one ever did it in a significant way for middle market lending on balance sheet.
Just so our students understand that when we think about the bank market in the United States, you've got the 8 GSIBs, which is the 6 big banks that everybody knows and loves, plus State Street and Bank of New York. And below that, you've got this super regional concept like PNC and M&T Bank, which are hundreds of billions of dollars, some of them up at a trillion, but they're not considered money center banks. They're not considered globally systemically important banks. Certainly systemically important. If you had a problem at PNC, if PNC caught a cold, the banking system would sneeze. But you've got that happening there too.
In the way that banks compete with private credit, what are they doing? How are they competing? How are they making sure that private credit doesn't eat their lunch? And are the big six, let's call them, different from the rest?
Larry, I don't think there's much competition between private credit firms and the big banks, or banks generally, because if you look at the big banks generally don't want to do balance sheet lending to middle market companies, and the non really big banks risk appetites are really not consistent with what you see in middle market lending. So I don't think there's a lot of business that the banks are giving up to the private credit firms. I think where there is competition is on the large private credit deals, right? So a deal that's $1 billion plus loan that could have been syndicated, that's not. It goes in the private credit market. And so what the banks would like to do for that type of loan is they'd like to commit to it, underwrite it, and syndicate it, skim a fee. The private credit providers will just say, hey, we'll just take $1 billion down. That's where I think most of the competition is occurring in the private credit markets.
But those are big numbers.
Yes, absolutely.
And I'm sure that the banks want to maintain their ability to syndicate those loans and earn those fees. And they're certainly not going to let private credit take it away without a fight.
Well, there is a fight, but the private credit managers do have some significant advantages, right? They don't require credit ratings. They don't require syndication period. They don't have market flex, which allows banks to change terms if the market weakens. They also allow the borrower to have a direct relationship with its lender. So even very, very big deals, you might have a handful or maybe a few more than just over a handful of lenders. And the private credit firms can give significant committed but undrawn delayed draw term loans, right? In the LBO business today, purchase multiples are very high. So the way that a lot of the private equity firms are trying to create equity value is through a buy and build strategy. And so they may pay 15 times for the platform asset, and then they're going to make a series of acquisitions for smaller companies where they're buying them at 8 to 10 times EBITDA, where they can average down their cost. And so to have committed delayed draw term loan facilities are critical to private equity firms, and that's a real big advantage that private credit has. You can't do very large unfunded delayed draw facilities in the liquid markets.
So essentially, you're saying it's the flexibility that's one of the big value-added propositions of the private credit market.
Yes, for sure. And it's speed, it's certainty, it's no ratings, no syndication period. There's a number of benefits of private credit, and it's why sponsors or other borrowers are willing to pay a premium to liquid markets.
Did we look forward to the banking system being less profitable or grow less quickly than it would have grown without private credit?
No, I think the banks are more profitable because I don't think middle market lending is a profitable business for most banks. From a just right, the same amount of work to make $1 billion loan as a $100 million loan, and so you don't get the overhead absorption, and then from a capital perspective. So no, I think banks are more profitable as a result of it.
As private credit gets bigger, though, won't they start to take another piece of the banking industry's profits? Because their capital base will be increased and they'll be able to compete on loans that they weren't able to compete with 2 years ago.
Possibly, but I do think that the banks are also on offense, right? They're lending to the private credit firms. They're going to try to trade private credit loans, right? To create new fee streams related to this. Banks are pretty good at adapting to evolving markets, and if they can do it in a way where they can do it in a less capital intensive way, it's more profitable. It's what their shareholders and regulators want. So I don't think there's necessarily a fixed pie that people are fighting over. I think as private credit evolves, there's more opportunities for banks to provide more services.
Has private credit, Ken, I'm going to address this to you because you're the academic. Has private credit have they just built a better mousetrap?
No, I think they've just expanded the investor base. I think, as Hank points out, the money center banks got out of the middle market lending business. I remember times 40 years ago when you'd go to a street corner in Midtown, and on the four corners, you'd have four banks. Everybody was trying to do the same business, and all the big banks were trying to do it. Now you segmented it out to the extent that you've got other players willing to come in and take a slightly different kind of risk in another segment of the market.
Do you agree with that, Hank?
Yeah, and I will tell you, if you look at the private credit industry, by and large, it's been well managed. There's risk management processes are very good. I think disclosures are good to investors. And they've has the asset class been tested in multiple cycles? Arguably not, but it did very well through COVID. It did well through the Ukraine Russia war. It did well during the GFC, but again, the GFC was the asset class was relatively small at that point. But it's been a well-managed asset class, and again, I think it bears repeating. Over a very long period of time, private credit has had lower defaults, not dramatically, but lower defaults, and they've had higher recoveries, again, not dramatically, compared to the broadly syndicated market. So, at least using history as a judge, the asset class has been managed very well, and I would make the case probably managed better than the banking system, and certainly more efficiently.
And are they getting the quality of talent, human talent, within the banks, within the private credit?
100%, without question.
And is technology in their favor because they can anticipate more loan problems than they could in the past?
I'm not an expert. Maybe Ken, maybe you can answer it, but I think banks, the large banks might have an advantage in technology because their technology budgets are just enormous, in terms of billions and billions of dollars. But Ken, you probably can answer that better than I could.
Oh, certainly technology budgets have ballooned. I don't think that's happened very efficiently because many banks have very bloated technology budgets. I think that technology certainly changes the game as people start to use AI type tools to evaluate credits. I think that's certainly on the horizon because there are all kinds of subtle things that AI, particularly machine learning techniques, can pick up on that your run-of-the-mill financial analyst just isn't going to see because there's so many other factors that can affect valuation. So I think technology is a key piece of it, and I think Hank's right about the efficiency. when you're a bank, a huge chunk of your technology budget is dedicated to regulatory and accounting requirements. That's much more simplified in a private credit setup.
Do you see government becoming more interested in regulating private credit for fear of what's going on, not knowing what's going on, looking at an opaque business and thinking it could cause a risk to the system?
I keep looking for where that risk is, to the extent that private credit investors tend to be large institutions. Now, let's be clear, large institutions like pension funds, ultimately that affects mom and pop because that's where mom and pop have their pensions. But as part of a diversified portfolio, I'm not seeing right now, I'm not seeing the excuse the Fed, or particularly the OCC, the Comptroller of the Currency, which regulates and charters national banks, are going to have to say, okay, private credit market, open up your books. We want to take a look because we think you're a threat. I'm not seeing the same issue there, because for the banks, everyone's going to say moral hazard. We have to protect the depositors. Moral hazard. We have to keep the credit market from collapsing so banks don't start pulling lines from everyone and the economy shrinks. I don't think we have that same thing going on in the private credit markets.
Yeah. And Ken, I would say that I think that the regulators do have a view into the private credit market, right? Because the banks are lending to the private credit funds, and they see that, so therefore the regulators have access to their portfolios. And, again, to date, the private credit market has performed quite well.
I've never met a regulator that doesn't want to look into more and more companies. Just saying.
And does private credit charge interest differently? And I'm thinking of floating rate versus fixed rate than do the banks, or is it completely similar?
No, the vast majority is floating rate, just as is the banks, but there are some funds, and I've managed them in the past, where you prefer the fixed rate. But I would say that 85-90% or more of the market is floating rate in the private credit market, and the same holds in bank lending.
Which is interesting to note that in the bond market, only about 25% of bonds are floating. So bonds are overwhelmingly fixed, loans are overwhelmingly floating.
And can private credit firms rid themselves of what they perceive to be risky credits in any way?
Can they what, Larry? I'm sorry.
Can they rid themselves? Can they sell some of the risky credits? And if so, to whom?
Well, I think it depends, where they are in their credit life cycle. I think if you can identify a problem early on, you could probably move it to someone in your syndicate, in your private credit syndicate. Maybe it costs you a couple points down. I think once it becomes clear that the credit is troubled, then you can sell it, but you're going to sell distressed investors at significant discounts to par.
Gwen, I see you have some questions from our audience.
You're on mute, Gwen.
You have to unmute, Gwen.
Thank you. Yes, there are questions, and actually quite a few came in regarding regulation, which you have just touched on, but there are still several others. One question, quite specific: do private credit firms participate in markets for financing venture capital and startups?
It's a tiny part of the marketplace. I would say startups, it's essentially zero. There are some venture credit funds. Morgan Stanley has an outstanding one, but those companies have revenue, and typically are, if not slightly positive from an EBITDA perspective, they're break even, and they're well on their way to profitability. But in terms of true venture capital or startups, it's really equity risk, and it's almost always financed via equity.
All right. One questioner asked about, do you see significant growth in private credit in the future? And hypothetically, if we go into a recession, how would that impact this market?
Well, I mean, I'll start, Ken. Yeah, I think the market will continue to grow. It's performed well. I think there's strong and growing interest from investors. It's grown very fast, right? There's been a lot of press about how fast it's grown. The private equity market's grown faster, right? So if you look at it on a relative basis, the private equity market has grown even faster than private credit. And one of the big drivers of demand for private credit is the private equity market. So yeah, I think it will continue to grow. Will it grow at 16%, for the next 7 years? Probably not, but who knows? And then in terms of defaults, if there's a recession, private credit will not be immune, but nor will high yield or the broadly syndicated market.
Ken, would you like to weigh in on that also?
I agree with Hank. I think it's interesting to note that for most of our students have lived through a nasty recession. Yes, we had a sharp decline with COVID. But when we're talking about a major recession, you think about what happened after the financial crisis, or I think about things that happened back in the 1980s. We used to joke a couple of years ago. Some kids on the trading floor had never seen a down day, and we're going to have recessions, and they're going to hurt, and companies are going to fail. I mean, that's why we have a bankruptcy process, and a bankruptcy process is the hallmark of an efficient capitalist economy. Because you need to have a way for investors to be protected, so people can create these ventures, all these entrepreneurial ventures that are out there.
I just want to add, Gwen, that many of the young people today really don't know what a down market is. I'm obviously older than everybody else. When I broke into the business in the late 60s to the early 80s, I don't remember the exact years, the market made no progress whatsoever. The market was flat for all those years. If you looked at what it was priced in the late 60s and the early 80s, it was the same price for the general market. Young people don't know how irrational markets can be sometimes. I'm sorry, go ahead.
No, it's fine. Actually, questions are still coming in, but here is one that came in a few minutes ago. The first interest to private equity reaped the first mover returns as they were able to find the best deals, the quote unquote low-hanging fruit. Over time, competition has eroded private equity returns. Should we expect the same in private credit as more firms enter and the market expands?
I think the short answer is yes. I think 15, 20 years ago, you could get, better spreads you can get today with less leverage. And, as an emerging market, there was real significant alpha achievable. But, 20 or 25 years later, there's still alpha. No, is it to the same degree? No. But if you look at the, risk-adjusted returns relative to liquid markets, you're still earning alpha, again, with lower historical defaults and higher recoveries. Just to date myself, so when I started doing LBO financing in the early 90s, private equity firms, when we were running models to see if deals would work, the private equity firms needed a minimum of a 30% return on equity. And then that became 25, and then it became 20, and then it became 15, right? So as that market matured and there was more competition, kind of the free money went away. I think that, as the asset class has grown, there's certainly a lot more competitors today than there were, 15 or 20 years ago. And there is more competition. But the good news is the asset class itself is growing very fast, and it continues to deliver alpha relative to the liquid markets.
All right. We have time probably just for one more question, of which there are several here, but I'll pick one almost at random. Nobody sees a systemic risk until it occurs. Why should we expect private credit markets to avoid crises the other credits have historically experienced?
I don't think you
if they
should.
will.
Yeah, I don't think you should. I think, listen, if there is a significant recession and a default cycle, I think private credit certainly will not be immune. If you can, without overly simplifying it, if you just use the past as a guide, what will happen is the private credit market will default less often and have higher recoveries. One of the benefits of private credit is when you have a handful of lenders to a company, it's much, much easier to get a consensual restructuring. You can stay out of bankruptcy. And that accounts, I think, for the higher recoveries in the private credit market. And so that advantage will be more significant if we have a significant recession and default cycle.
Okay, that's very
I
promising.
just want to ask
Larry,
one-
this is,
I want to ask
Oh.
a follow-on question to Hank. Hank, are the banks forming their own private credit funds?
Yeah. To my knowledge, every big bank has a significant private credit effort, and largely off balance sheet, but some are doing it on balance sheet as well.
So they're funding the competitors and competing with the competitors
Yes.
at the same time. Very complex. I'm sorry.
it's okay. There's one last quick question for you, Larry. For our undergraduates who are studying finance, would you encourage them to have a traditional banking credit experience or actually look right off the bat for entry-level positions in private credit? Or does it really matter which they would start out in?
So I would say two things. One is, if you're going to be an effective credit investor or banker, you really have to know accounting. So don't leave Baruch without knowing your accounting. I would recommend everyone take at least intermediate one, because that is the language of business. You really need to know accounting.
Completely agree.
So I would say that. In terms of private credit, I think the vast majority of the firms require you to go work at an investment bank or a big bank for a few years to learn credit training, like I did a long time ago. So it's pretty atypical to hire directly out of undergrad because they want you to get the experience of credit training and making loans and see how the sausage is being made.
Learning credit training will never harm you.
That's true.
Thank you all. I think we'll have to leave it there, although actually questions are still coming in. But I wanted to mention that next month's webinar is why corporations are leaving Delaware and what does it portend for shareholders. The date will be May 13th at 11 a.m. The guest will be Paul Roth, founding partner emeritus of Counsel, Schulte, Roth, and Zabel, LLP, and Thomas Baxter, senior fellow at NYU Law School, managing partner at law offices of Thomas C. Baxter, and former general counsel of the Federal Reserve Bank of New York. Thank you, Ken. Thank you, Hank. Thank you, Larry, for a really interesting discussion.
Thanks, everyone.
Thanks, everybody.
Thanks, everyone.